Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jens Nordvig, his book on the euro was outright courageous over a decade ago, acclaimed on Wall Street and now at Exante Data. Can dollar weakness continue?
I think it can. It can. It's we were talking about a couple of months ago, and what happened a couple of months ago is we had this pretty big, dramatic shift in how people think about asset allocation. So a lot of our clients have been taking down their dollar exposure from Canada to Europe to Asian countries. So I think we're well into that process. People have done a lot of that. So I think we're going into a new phase. And I would echo what you're saying. I think that Scott Besson interview was fantastic, very transparent. But I think we're going into a new phase where it's more about the Fed again. Like, is the Fed going to do something?
Right.
Is the pressure on the Fed going to have an influence on the dollar? I think actually what you're seeing this week is that the dollar is kind of leaking. And
exactly, perfect. Yeah, the leaking captures
it's kind of because investors are a little bit uncomfortable with this pressure. And I think that's adding to a new phase here. That's not just about, FX hedging, but it's think about what the Fed is going to do in coming quarters.
So, I mean, all right, you're selling the dollar. We've seen other risk assets come back. The U.S. S&Ps come back and so on.
Yeah.
And you're selling the dollar. What are you buying?
So,
I mean, where am I getting better growth than the U.S.?
Yeah, so I get this question. I would say not every day, not every week, but regularly I get this question like, what else is there to buy? Right? So you look around the world, and the point I would make is the following, right? We're not in a zero interest rate global environment anymore.
Yep.
Like, there are fixed income instruments you can own in Europe, other places in the world, right, where you can get some yield, right? So from a yield perspective, it's not as one-sided as it was where the U.S. was the only place in the world you can get any yield, right? So there is some competition from a yield perspective. And we've seen in equity markets, even though you've had the big bounce in U.S. stocks, they're actually still lagging relative to a number of global markets, right? So I think there's a lot of equity investors that after several years where you had to be focused on the U.S., there are alternatives, right? So people are looking at European banks. Like there's something going on with European investments where European banks are going to play an important role, right? So I think that's one place that people are looking. Assets are still relatively cheap around the world, right? So if you believe that valuation has any role in asset allocation, that's an argument. But there's also a basic diversification argument. Bloomberg had a good story yesterday about how some of the big Canadian pension funds have diversified out of the dollar. It's very consistent with the conversations we have with chief investment officers around the world, right? Dollar exposure has been taken down from a very elevated level going into this year.
So inflation here, I think most people feel like was kind of a benign reading yesterday, a little bit of a tick up, depending upon how you want to look at it, but I think less than maybe some people expected. Are tariffs going to find their way into the inflation data, do you think?
This has become a quite controversial topic, as you've seen. I was in touch with Jan Hatzius yesterday. He's obviously feeling some heat from having put out views on this.
His badge works downtown this morning. we got to recapitulate this, folks, and slow down here. This is important. Jens Nordvig, working for years with the younger Jan Hatzius. Jim O'Neill set up modern Goldman Sachs economics with a guy named Bill Dudley and Ed McKelvey. Mr. Dudley, of course, went on to the New York Fed. They had all these young whippersnappers walking around, and one of them was a guy from Germany named Jan Hatzius, who single-handedly codified mortgage equity withdrawal within global Wall Street. That's how I first came to know Jan Hatzius. And Jens Nordvig was absolutely this guy out of Copenhagen, like he knew every restaurant in Copenhagen. And they and others, they put together this just incredibly eclectic and original team under Jim O'Neill and Bill Dudley leadership. Jens Nordvig went off to do other things, including founding Exante Data. And Mr. Hatzius at some point was promoted up the food chain to getting the radar of Donald Trump.
It's a good summary, Tom.
Yeah.
Like actually, like when I moved to New
What
York.
did Jan say?
Well, it's rare that you have a situation where the president of the United States is involved in some kind of tension with an economist at a bank, right? So we're in an unusual situation. So I think Jan is going to continue to do his research, continue to do his forecasting, and hopefully the management will be dealing with that appropriately. But going back to the question, the tariffs are coming through in the numbers, but we should also be very aware, right, that the tariffs have not been going up linearly. We had a huge tariff shock, and then the tariffs actually went down. Like the Chinese tariffs went up above 100%, and then they went down. So when we analyze the monthly inflation reports, we have to be very precise about, was this a month where tariffs actually went up or down? Mm-hmm. And I would argue that the report we had yesterday was actually reflecting that the tariff rates on China came down into that report, right? So when we look into the coming months, which is obviously what investors care about, the future, not the past, we are looking at a new shock from the reciprocal tariffs kicking in here August 10. That's going to be in the inflation numbers mostly in September and October, and it's not going to make the Fed's job easier.
I want you to take the microeconomic foundations that Bill Dudley and company demanded, and you were expert at, and walk through the x-axis of tariffs in your study. In America, we would go back to William McKinley. I'm going to say 1899 off the top of my head. The exporter adapts, the importer at the shore adapts, and then it's passed on to the consumer. What's that x-axis look like?
Well, we had an initial shock, right, in April that only lasted a couple of days. So that's kind of noise. Like, so where did we settle in April? Right? We had a shock in the region, 13%. Right, so if we put that 13% in the context of having had 1 or 2% before, it is a dramatic shift, and companies are adjusting at different speeds. So there's some goods categories where companies have passed it through already, and then there are sectors where companies have a lot of influence on their price. Apple has a lot of influence on their price. They don't have that much competition for iPhones, right? So they can set it, and they have not passed it through. In the auto sector, Toyota is a very important company, and they have not passed it through. Other companies in that sector are then waiting, what's Toyota eventually going to do? If Toyota moves, we're going to move as well, right? So it really depends on what good it is, what that pass-through has been. It would be surprising if there's not more pass-through over time, especially since tariff rates are now going back up. But I think what is also tricky is, like, how much should the Fed look through? Because, like, it used to be the case that the Fed viewed tariff as, okay, it's a one-off shift to the price level. We have to mostly look through it. And I don't want to be too critical of Powell, but I do think there has been a bit of an odd shift within the Fed where they're focusing very much on realized inflation. What is the inflation next couple of months, as opposed to saying there's an element of the price level shifting in a one-off way. And it used to be the case that they wanted to look through that. And I think...
Yeah, Besson alluded to that.
Yeah, I think I actually agree with that criticism, to be honest.
Yep. Yeah. And so inflation is one thing. We got some data yesterday. How about the labor market? Fed is also looking at the labor market. And again, we had some odd data with some revisions last week. Yeah. It just kind of puts that front and center once again.
Yeah. Like when we looked at the labor data, not in the last report, but in the before that, it looked really odd that there was this surge in governmental hiring. Like it was totally in conflict with all the anecdotes we're getting, right? So the data did look odd. And now we have like a big revision to what's happening in the government sector that actually makes it look less odd. The private sector is probably where we really should focus, right? Because it's deliberate that we're reducing the public sector employment, right? It's like an actual policy steps that's very deliberate. But what's happening in the private sector is more important. And I think the data there is very tricky. We have a real-time labor indicator that we're tracking, right, where we look at everything that is a signal in the labor market, and it's not falling off a cliff, that's for sure. There's some gradual deterioration, and then recently, it's actually not obvious that it's getting worse. So the Fed is dealing with this thing where the revisions look very bad, but it's not obvious that the momentum is getting worse. It's tricky for the Fed to handle.
One final question. This is from Paul from New Jersey. Your book is The Fall of the Euro. Can you get the euro to parity before the third week of September when Paul's going to Europe?
My book was written a few years ago, and we did have some problems with the euro in the meantime. But as I think you texted me the other day, Tom, you said, why don't you write The Fall of the Dollar instead? Like the dollar has some issues as well.
Can we get some news here? Are we going to get a new book?
I would like to write about the dollar. I have to get approval from my wife before I write another book.
It's compliance.
But the irony is that the administration wants the dollar weaker, right? So it's not like it's not just like it's something that happened by action. It's actually something that the administration wants by design. So there's some structural changes here that we should not underestimate, and this is why I think we're going through these phases where the dollar was weakening due to the capital flows in the first half. Now we're going through the Fed phase, and we've been through such a long bull run for the dollar up until this year that we can have multiple phases of dollar weakness from here.
Jens, thank you for waiting for after the Besson comments as well. Jens Nordvig with Exante Data.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
David Seif joins us. He's with Nomura, their lead economist. And I do this because I can't convey to you folks the intimidation of this list of people. Harvey Rosen, Lawrence Summers, Jeffrey Sachs, a guy named Elmendorf, who was pretty good at CBO, as I recall. Stephen Mirren, very much in the news with President Trump. And David Seif, you had the honor of studying with Martin Feldstein, who was such a supporter of mine. Let's start there. Do you worry with all the heritage of Marty Feldstein about our debt and our deficit?
Oh, absolutely. I think this is a very indebted country that we have, and there isn't much prospect of that closing anytime soon. We're not running deficits right now in order to stimulate an economy that's in recession. This is just a very large structural deficit that has developed over decades, and there's no sign of it going down anytime soon. Without
getting you in trouble with compliance at Nomura, Ken Rogoff in my book of the summer, Our Dollar, Your Problem, makes clear we could see the long end of rates go price down, yield up, and burst through. Is that, I don't want to get you in trouble at Nomura, but is that an outcome that's possible, not probable?
Well, fortunately, we've already written about that, so I'm not at risk of getting in trouble for opining on it. Yeah, I think this is an increasing investor concern, and I would say a concern of mine as well. Over the past couple of months, we've seen, I'd say, really starting in April with sort of post-Liberation Day announcement, and then events in the UK, events in Japan.
Red Sox got Bregman,
exactly. We've seen crisis happens, the back end sells off, the crisis then is resolved, and the back end doesn't come back. So the yield spikes, and then when the crisis is solved, it just sort of stays there. It doesn't get any worse, but we've seen this steady steepening of the curve, and it's not the good kind of steepening. It's not the kind of steepening where people are like, the economy is going to be growing better, and therefore longer term rates should be, or yields should be higher. It's the kind of steepening where people are like, I'm a little worried about what inflation is going to be like globally. I'm a little worried about, what the future holds in terms of risk, and therefore I demand a higher risk premium for locking my money up, even with these very safe, developed market economies like in the US, UK, Japan.
David, are you surprised that we haven't seen more inflation in this U.S. economy yet? Or is it just a matter of time? Or maybe the corporations are just taking it in the margin. We're not going to see it.
Well, I mean, you can't argue with the data from yesterday. We did not really see the signs of tariff-induced inflation that we had been expecting. Inflation, core inflation did tick up a little bit. But really, when you broke it down, it was things that were not related to the tariffs that happened yesterday. And that was actually in contrast to a month prior, where you did see some signs. There wasn't the follow through in the data yesterday. And I think that does open the door for the Fed to certainly be cutting in September at its next meeting as a result.
And I guess it seems like in the space of 24 hours, we went from saying, okay, I guess a 25 basis point cut is locked in for September. Now, the rhetoric over the past 12, 18 hours has been maybe 50 basis points.
Drinking game, Tito's and Tang, 50 beeps. I'll go there.
How do you think about that?
It certainly can't rule it out, but it's not our view that it's going to happen right now. There are a couple of things. The first thing is that the economy still looks like it's okay. The economy is still growing. We had a decently robust second quarter GDP print, not perfect, but the labor market, despite having a big negative downgrade, we still have a 4.2% unemployment rate. And then on top of that, I think the Fed probably remembers last year, it looked like it overreacted by going 50 in September last year.
Paul, can I go theoretical?
Go.
It's Wednesday, no economic data. If you have nominal GDP and it's an impulse from real GDP, lesser inflation, as compared to an impulse of inflation rising with a lesser real GDP, are they equal? Are they efficaciously benefit to society, or is there a difference in those two nominal GDPs?
I think there's a big difference. I mean, I think we certainly would always hope that it's being driven not by prices rising, but by real actual production of stuff, right? That's what real GDP is.
Which do you see right now?
Yeah. Well, right now we see a little bit of both, right? And so that's not necessarily quite as good as before, but where we had more of it coming from the real GDP growth side. But I would also say it's pretty far from a disaster. However, for companies, companies are trying to hit nominal targets, and it's not as important for them. And I think, when we had the inflation, episode in 22, 23 following COVID, a lot of companies did really well just because their nominal earnings were going up as a result of that. So I do think that for, going back to what you were saying before about the stock market, a little bit of an increase in inflation, whatever the cause may be, is probably good for these companies over the shorter run.
And this is critical. This was Phil Correa at Pioneer years ago. The bright lights of inflation help everybody.
Exactly. Friday, we're going to get retail sales. David, how's the consumer hanging in there, do you think?
The consumer we actually still think is pretty good. We've seen retail sales growing slower than earnings have been growing. And I think on top of that, one key thing, and this does go back to the labor market, even though we've seen now several months of relatively weak job growth on a net basis, on a gross basis, there's very few layoffs, right? And what really kills retail sales is not a lack of net jobs, but people being laid off, right? And right now, job security remains very high, almost as high as it's ever been. So your odds of being laid off, if you have a job, are extremely low.
I can't tell you how many of our listeners and viewers disagree with what you just said.
Yeah.
I get the mail on it.
You're
happy to
saying
take that. Job security is okay.
Job security is a lot better than it would typically be with these level of NFP. Absolutely.
Don't be a stranger. David Seif, thank you so much. He's
My pleasure.
with
My
Nomura
pleasure.
This morning. Really wonderful to have him in with the privilege of studying with Martin Feldstein at Harvard a few years ago.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Everybody's going rationalize, rationalize, rationalize. What Brian Belski does at BMO Capital Markets is he does 7 pages and you hate him because you have to read. Usually I skim like the first paragraph and, move on.
Sure.
I can't do it with Belski. You can't do that. What's your paragraph 4 say right now, Brian Belski, about the fact there isn't exuberance? Like I look at some of the major houses' analysis of the hedge fund enthusiasm, the market, LO, long only. It's not a roaring bull market. It is, but it's not.
Well, good morning. We've run out of ways to try to explain this, whether or not we're climbing the wall of worry or the most hated bull market ever, which we talked about 10 years ago. And I think it's just this notion of so many investors from the institutional perspective, Tom, just love making binary opinions, meaning I'm out, I'm in, I'm bullish, I'm bearish. There's nowhere in between.
When you and I studied, it wasn't like that.
It wasn't like that. And there's so much talk of small caps will never work again. Oh, by the way, now everybody thinks we're going to cut rates, so small caps are up today. I mean, that's not investing, right? And so we really believe that this big secular bull market has had several different versions of it. We think we're entering a new version of it that could last another 10 years, part of our 20 to 25 year secular bull market theme and theory that we've been consistent on in the marketplace since 2009, 2010. So what's going on right now, and to answer your question on hedge funds, remember hedge funds have had terrible performance the last 3 to 5 years. Long only have been late to come in. The people that have been right in terms of investing have been private wealth and family offices because they have maintained their investment perspective and been much more disciplined.
The S&P 500 futures just below 6,500, as Tom was mentioning. You say your 6,700 target is too low. Why is that?
Well, I mean, our bull case is 77,000, 7,200. We think that earnings are going to be a little bit better than everybody thinks.
So rolling forward 3 months.
Very much. Well, I think it's 3 to 6 months, Tom. I really do. And I think where the big kick is going to come from are financials. The financial strength in terms of the really big banks, but also the brokers. I think we're going to have a bang on second half, especially fourth quarter in terms of investment banking. Tom mentioned the word exuberance, Paul. Mm-hmm. If you think about irrational exuberance, not everybody's making money yet. So the more you talk about a bubble, there's no bubble. There's no bubble. Just because things go up doesn't mean there's a bubble. When everybody's making money. So what do I mean by that? Financial services, big banks aren't making a lot of money in terms of the tech trade or the AI trade because we're not seeing massive amounts of IPOs. But more importantly, we're not seeing quote unquote silly types of mergers, like big company mergers done with stock. When we see that type of stuff, then we're getting closer to the end, but we're nowhere near that.
So are we sticking with what's got us here? Tech, comm services, that kind of thing?
You know what's interesting is that back in the 90s, we bought big cap stocks, the Nifty 50, and the rational exuberance that Mr. Greenspan talked about was actually about stocks like Procter & Gamble and Gillette and Coca-Cola. But you know what those stocks are now? They're Google, Apple, Microsoft. They're liquidity. And so what happens when people get worried is they come right back into liquidity because they can participate in the market. So as the market kind of gets a little bit lofty here, we're going to see more broadening out. Then we'll get some sort of a pullback. This is all very normal. And guess what's going to lead coming out of the pullback? Large cap tech again. Yep. So we think from a secular basis, there's several areas of tech, not all of tech, right? But there's several areas within tech that you can, will, and should be more stock picking oriented.
All right. We got some data over the last couple of days that seems to have solidified a 25 basis point cut. I don't know, the last 12 hours, I woke up to my scroll was saying, hey, how about 50 basis points? What are we doing there?
Yeah, I think that's kind of wishful thinking. I think that the Fed, in our view, would be jumping the gun at 50. I think there's been an increased talk about that, quite frankly. And what we've said is that the market's trend is not dependent on the Fed cutting. This is all about earnings and all about the market recovering and actually people getting reinvested again after missing this move.
I want to get back to what our listeners and viewers should do that don't speculate. I mean, they watch the parlor game, as I call it, and, they're entertained by it. but they just want to. There's a wall, as Larry McDonald says, there's a wall of money out there, and it's going to go in. Is the money going into the market by conservative family office, private wealth, and that? Is that forever money that's going in? You just assume they're buying at the margin, whatever sector, whatever stock, whatever, and it's like forever?
Well, I think what's happening is you have a lot of baby boomers that are retiring, and then with their retirement and that 401k money, they're able to roll it over in an IRA. I think a lot of people aren't talking enough about that, number one. Number two, in terms of this forever money, remember too that because of the binary decisions of a lot of people selling bonds, quite frankly, at the low, I think that there's still an opportunity to be in 60-40 and be more diversified. On the forever money, I think what we've encountered in our great private wealth platform at BMO in terms of not only private wealth but asset management, they've been very consistent and more disciplined in terms of when the market goes down, they average back in. And where the institutional world usually has to sell because they're getting a call from their compliance department and they're oversized NVIDIA or something, where a private wealth person can say, oh, I need to mark the market. So I think the forever money, it's difficult to say forever, but I think the more consistent, more deliberate type of strategies, whatever your value, growth or whatever.
Brian, I don't care. Here's what I care about. A kid is, like he's sort of recruited. He's not like a star. He's not like, whatever they call him, 5-star high school kid. He ends up at Louisville, sort of grows up at Louisville, ends up at Florida, and then through 3 teams, he ends up making $76 million with the Minnesota Vikings. This guy, Jonathan Greenard, is like the real deal. Who is this guy?
Out of nowhere, but you got to remember too that coaches put people in the right position, and we have an amazing defensive coordinator, Brian Flores, that is basically a co-head coach, and I think he might be one of the highest paid assistant coaches in the league. But this guy's amazing. He can take anybody. He took Andrew Grinkle, so he's got a cool name, from the Miami Dolphins last year. It made him a superstar.
How do you think this is I got almost like goosebumps here. This guy Greenard, was really sort of struggling. Bam! With the Vikings, he's a Pro Bowl superstar with mega money.
Vikings are. I mean, this is coming from a Minnesota fan.
Really? I
Twins
didn't know
are in
that.
town getting crushed by the Yankees again. But you're welcome. The Yankees need a little pick me up. But at the end of the day, I think the Vikings are well positioned within a division. As you know, I think the Lions are going to be down. I think the Packers are going to be down.
J.J. McCarthy against the Detroit Lions, November 3rd. I know you'll be there. Can he do it?
He looked good, and he looked good in the preseason. We're all excited.
We'll leave it there. Finally, Brian, you got to understand, folks. Belski walks in with an entourage of like 7 people, and one of the interns whispered to me, "Talk about the Vikings. He's excited about JJ." Brian, thank you so much.
Thanks, man.
I can't, folks. We keep score here. We really want to listen to the people that have gotten it wrong. Okay, you can learn more from them. But the people that we identify that have gotten this bull market right, we want to listen to them now with futures 6,500, Dow futures pushing up on 45,000. Brian Belski, BMO Capital.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Stephanie Baker, we're thrilled, joins us here before Alaska. Stephanie, thank you so much for joining us. I know we've been gyrating around with some wire stories this morning. In your book, you talk about capping Putin's war premium. What are we doing in Alaska? Are we trying to cap the hopes and dreams of Vladimir Putin?
No, it does not look like that's what Trump's going to do. This summit in and of itself is a huge victory for Putin. He's an indicted war criminal under U.S. sanctions being welcomed on U.S. soil. And the symbolism of holding this in Alaska is not lost on anyone. Very close to the United States. They're going to sit down at a military base. The Friday deadline of severe sanctions, if Putin doesn't agree to a ceasefire, has come and gone. And we still don't have any additional sanctions by the U.S. Trump hasn't imposed any additional sanctions since he entered the White House. This additional tariff on India of 25% doesn't actually come into force for several weeks. So, it really remains to be seen whether or not we will be back at the debate about whether to sanction Russia additionally, after Friday.
Putin's been in office, longer than Peter the Great or Catherine the Great. Stephanie Baker, we're aware of, with good spirit, how President Trump is aged. How has Vladimir Putin aged towards this meeting from Helsinki and from his early years out of the KGB? Putin obviously has staying power, and the war is part of his gambit to stay in power until he dies. There's been a lot of speculation about Putin's health and wild rumors of body doubles being seen. Putin lookalikes going to visit troops, with the border close to the border with Ukraine. I think Putin, from all accounts that I'm familiar with, Putin is in fairly good health for a Russian man of his age. So I don't think he's aged in any material sense, in that sense, since 2018. I am bracing myself for what will inevitably be a very bizarre press conference after this summit, because as we remember the 2018 Helsinki summit, it was a very bizarre and depressing, press conference afterwards, where Trump questioned the legitimacy of U.S. intelligence that Russia interfered in the 2016 election. This is not going to be a straightforward press conference afterwards. So I think that we'll be watching the words very carefully as to what they agree on, if anything. Stephanie, Vladimir Putin, does he have the support of the elites of Russia or the Russian people?
Putin runs Russia with an iron fist, and there's no real room for dissent. The fear of being thrown into prison for even the slightest offense is extremely high. So I think the elites would love to see a deal here. They want the sanctions lifted because for all the talk and the bravado of Putin that Russia's doing just fine under the sanctions, in reality, the Russian economy is in a real bind right now. The economy is slowing, inflation is high at almost 10%, it's high interest rates. The banking sector, as we have reported, is worried about rising bad loans. And I think that the elite is really counting on sanctions relief. So they want him to do some kind of a deal. Of course, he's got their support, because if any of these oligarchs go against him, they will have their assets taken and they will be thrown in jail. At the very least.
To the market opening here, we're thrilled to bring in from Queen Victoria Street, Stephanie Baker. The book is Punishing Putin. It's definitive. She is most up to speed on the economic and political consequences of Russia as we go to this summit. Our Anne-Marie Hordern will be in Anchorage. Paul?
Stephanie, are there any reasonable expectations for this meeting between Mr. Trump and Mr. Putin? Can anything of materiality get done, do you think?
I'm quite skeptical because, usually with these big U.S.-Russia summits, they are months of preparations ahead of time. There's some kind of an agreement that is, worked out ahead of time, and that the leaders come to just kind of seal the deal and sign it. This time, Trump has billed it as a kind of feel-out summit, which is a very bizarre way of going into the first U.S. summit in 4 years, and the first time Putin has been welcomed on U.S. soil since 2007. So he doesn't have a lot of Russia expertise at his side, because they fired so many people from the State Department, and they don't have the kind of Russia expertise on the National Security Council either. So the idea that he's going to go into a meeting with Putin and come out with some sort of detailed land swap is really unrealistic. I think at best they will come out and say they're going to kick this to working level groups. and it will continue to drag out, which is in Putin's interest, because actually Russian troops are gaining territory slowly, and it's a grind at huge, enormous costs. But Putin's goals here have not changed fundamentally. He does not want Ukraine to be part of NATO. He wants caps on Ukrainian military. And his central demand is that he wants the remainder of Donetsk that Russian forces do not control on the ground. And that is a non-starter for Ukraine, because that's where they have their strongest defenses, protecting other Ukrainian territory. If that goes, then that leaves Ukraine very vulnerable for additional Russian attacks towards Kharkiv and other areas.
Stephanie, what role, if any, will President Zelensky play on Friday?
Well, he hasn't been invited to the table, which has led to a lot of people comparing this to a kind of modern-day Munich. I think there's fear in Ukraine that land will be handed over to Russia without them even being at the table. Trump has said he will call Zelensky right after the summit. They're having a call today between Trump and European leaders, as well as J.D. Vance and Zelensky, and I think that they're trying to present a united front, warning Trump of the dangers of, legitimizing Russian territorial gains in Ukraine at this summit. That they need to agree a ceasefire before any broader negotiations actually begin. So whether or not that message gets through, whether or not Trump listens to it, I'm quite skeptical. But I'm also quite skeptical that they're going to be able to come up with anything meaningful out of this summit.
We'll say goodbye to Stephanie Baker and we'll get her on again.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Saving us this morning, we're not worried about a cable.
No.
To Milwaukee. Well, we should be, because the rain there has been so bad.
It has been terrible.
We're lucky Brent Schuette's with us. Brent Schuette, Chief Investment Strategist at Northwestern. Brent, quickly here before the market opening, the flooding in Milwaukee, I did the math, 14 inches of rain. Is that true?
That is absolutely true, unfortunately. Around my house, we had about 13 inches of rain, which was quite a lot and more than I'd ever seen in my life.
Wow. Absolutely amazing. With some real hardship for Milwaukee. We say good morning to everybody in the Midwest. Brent, the market grinding higher, almost a melt up. Are we just looking out to more buoyant earnings? If Northwestern Mutual looks at the pulse of the nation, is this about an earnings-driven new belief, or is it Fed-driven bull market?
I think it's a combination of everything. I mean, my big worry is we're 3 to 4 months into tariffs, and we're all concluding, at least investors are, that they know exactly how this is going to end. I think the tails are wider. I think it's unlikely you have the same type of economic environment that you had before, which led to that market leadership that was pretty narrow. I think the biggest thing for investors, to me, is just diversify. That's how you admit you don't know exactly what's going to happen as you go from tariff rates at 2.5% to something probably over 18, which we haven't done in 100 years. And I think if you think about that comment alone, to me, that means that everything that we're talking about potentially coming to fruition is based upon economic theory, not actual reality in a lab as large as the United States or the globe. And so I do think there are opportunities out there in small caps. I still think international stocks hold value, because I do think that the administration would like the dollar lower. And so there's still opportunities, but I would encourage investors to not get too far over their skis and to maintain their asset allocation, which their financial plan guides them towards, because they're trying to meet their long-term goals and objectives.
Brent, we've, I guess the 25 basis point Fed cut for September is kind of locked in, is what I've read off of the street over the past 24 hours. But now you're even hearing some discussion about a 50 basis point cut hit in September. What do you think?
Tell me what the jobs market does in September. All this CPI stuff is noise right now. Okay. Tell me what the jobs market does in that September print, and I'll tell you whether it's 25 or 50 or nothing at all. And that's where I think the reality is most Fed members are more concerned about the labor market. That's where, if both policy sides of the policy are in disagreement or are moving in the wrong direction, they will probably err more towards the labor side of the equation. And that's what I think is important. I don't think the CPI report gave the Fed any room to cut rates. But that's not the narrative right now. And even the Treasury Secretary on your show this morning talked about his belief they should cut by 150 basis points because if they would have known what the labor market numbers were, they would have cut then. So I think it's all based on that.
I mean, we got to get to the market open here, Brent. Good to tell you there's green in the screen, but isn't that just stimulus? Aren't we really just talking about a fiscal pop and maybe a monetary pop driving us forward?
Absolutely. I mean, you're stimulating a later cycle economy, and that's what I worry about. The good side of the equation, the inflation has moved up, and I think that's where people are suggesting that it's only 0.2% with tariffs being on right now for the second month in a row. My concern is more of what's happening on the services side, and all the different inflation indicators we at least have looked at in the past don't suggest that inflation is going lower. They suggest it's going higher.
Brent Schutte with us here with Northwestern Mutual. What's great about Brent, I mean this seriously, folks, if you're in quiet money like Northwestern Mutual, you have to go into a room with compliance people and lawyers, and you have to memorize, Paul, this phrase, part of a carefully balanced portfolio. And what I love about Brent Schutte is he's got like 8 policemen helping him. You're supposed to say part of a carefully balanced portfolio. Brent, we all own the Mag 7. What do we do?
Oh, I'm sorry, Tom. I don't think it's because of the policeman. I think it's because of my beliefs. Look, I've done this for 30 years. Towards the end of economic cycles, only certain parts of the economy are doing well, which is why only certain parts of the market do well. What happens on the opposite side, at least in my 30 years of doing this, is the market broadens out, and the people who unfortunately crowded into those areas that were working don't see their portfolios work for years. And if you're thinking about someone retiring and someone having cash flows and taking money out of their portfolios, that's the enemy of that. You can't have that happen. So I think about Japan in the 1980s. I think about the tech stocks in 2000. I think about financials and everything else, commodities in the 2007 period. I think about emerging markets back then. What happens is that there's a new economic cycle. Look, typically what resets that is a recession. This time, I don't know that we're going to have one, but I think you have reset the economic environment. And I think that means new leadership on the opposite side of this. And that's where I encourage investors to stay diversified. Everyone who comes on your show and proclaims they know exactly what's going to happen, I would have doubts they actually do. Otherwise, they might not be working. And that's where my suggestion is to remain diversified and to not concentrate, because it can make you spectacularly rich and spectacularly poor. And that's not the distribution that I want to deal with when I deal with my clients.
Paul, for futures, Paul, driving to a new high into the opening. In the opening, they continue. Futures up 20, now up 25. Dow futures up 186.
Now we got the market open.
NASDAQ up 0.2%, up 0.5%. Now the VIX 14.33. We're not letting Schutte go until the VIX is a 13 handle.
Brett, real quick, about 30 seconds. How do we play the fixed income side of the game?
Look, I think longer term, the 2% inflation target is dead. But I think in the near term, there's enough economic stress out there. You saw that in the labor market. You've seen that in consumer delinquencies, that you want to be just a little bit longer duration right now, because I do think there is some sort of potential for economic downside. I think longer term, I think things like tips will be more attractive, just because I do think inflation is the likely outcome from all this, even tying in my opening comments on the Federal Reserve erring on the side of the labor market over inflation.
Brent Schutte, thank you so much with Northwestern Mutual. Really, really appreciate that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.